Welcome back. You are watching the Oasis Focus on Finance show. And of course, just to remind you, we'll be coming to you every single week. If you would like to contact us, our SMS line and of course our email address will be on screen. So any questions, feel free to contact us and our experts will be in touch. We are currently discussing the current scenarios in the local and international markets. We've touched on China, we've spoken about Greece, and currently we're chatting to our investment analysts Daniel King and Fahad Sheikh. Daniel, let's start off with you. We have been discussing China. Now China, South Africa, import, export, export, import. So we do have a dual way relationship with China. But how is this going to affect us in terms of the fact that China buys a lot of our raw materials? How is this going to impact on the economic landscape?
I think you raise a very good point because China is a significant recipient of South African exports. It accounts for 36% of our exports this year. And furthermore, 63% of these exports are commodities. So what happens when there's volatility in China? Your commodity prices tend to decline quite sharply. And what this means for South Africa is that our so-called terms of trade, the price of our exports relative to the price of our imports, declines quite sharply. And that means that we have to export a lot more in order to afford the same amount of imports. So it really impacts the viability of our exporting industries when there's volatility in China. And indirectly, that starts to impact the value of the rand. Now, when the value of the rand changes or weakens, it makes our imports more expensive. And keep in mind that imports account for about 1/3 of all expenditure in South Africa. So it's a big chunk of our basket of spending. And that means that a weaker rand tends to stimulate some kind of inflationary pressures. So the inflation outlook starts to deteriorate a bit. And then that starts to impact on consumer demand. So China and any other large economy, large trading partner, will have a direct impact on the South African inflation outlook and the South African growth outlook indirectly.
Fahad, how do we actually shield our economy from this kind of volatility?
I think it's very important to diversify. I mean, Daniel mentioned that, China or be it some other emerging market, when China slows down, we see the impact on our commodity prices in our mining sector in South Africa, be it the manufacturing sector. So it just highlights that you need to have a much more diversified economic base. In South Africa's case, we need to focus more on industries or sectors of the economy which do have a significant competitive advantage. If you look at something like financial services and business services, that segment of the market, that sector of the economy has continued to grow very strongly relative to other parts of the economy. I mean, if you go back to the 80s, I think the financial and business services sector used to make up only 10% of GDP, and that's doubled over that time. Whereas over the same period, mining's probably gone from 40% of our economy to 18%. And I think if you look at some of the indicators which the World Bank, the World Economic Forum publishes in terms of South Africa's competitiveness on the financial services side, in terms of equity markets, in terms of stability of the banking sector, auditing standards, South Africa ranks top 3 within all those areas. So I think that highlights that we're very competitive there, and that is one area of the economy which is growing relatively fast, or better than the other parts of the economy. Then secondly, if you look at things like tourism, for example, I mean, South Africa has amazing natural resources. And even from a tourism infrastructure point of view, there's a lot that South Africa has to offer and a lot that South Africa can benefit from. So I think while the mining side and the resources side has come under pressure, and will if China is slowing down, but then other parts of the economy need to be strong enough to take that slack up. But obviously to achieve that, the key thing really is you need to have consistent policies from the government's point of view to ensure that you make the most or you benefit from these segments of the market.
Daniel, a big event for the consumer was the announcement by the Reserve Bank an increase in the repo rate, I think 0.25%, which means more to pay on the bond, more to pay on the credit card debt, etc., etc. How do we understand all of this now in the bigger picture?
I think it's firstly important to get a good idea of what the repo rate actually is. The repo rate is the rate at which the South African Reserve Bank provides funding to the commercial banks operating in the economy. And so it's very important for the rate on funding across the entire economy. So for example, anyone with a home financing or vehicle financing obligation is going to be impacted by that increase in the repo rate. And the reason for this is to reduce the rate of increase in the demand for goods and services in general. And so indirectly, you're starting to impact on the price, on the rate of increase in the price of goods and services. The Reserve Bank has a mandate to keep the rate of inflation in a band of about 3 to 6%. So as it sees inflationary pressures start to emerge, as it does now, it's going to have to increase the repo rate in order to contain those pressures. At the same time, it has a responsibility to not harm GDP growth unnecessarily. And so it's a very fine balance it has to strike between containing these inflation pressures and stimulating growth at the same time, which is one of the reasons why we've seen recent increases in that repo rate of only 25 basis points or so. It's a much slower rate of increase than what we've seen in previous hiking cycles where they've started to increase the repo rate.
Fahad, how important is all of this for us? Any increase in the repo rate does affect the consumer undeniably, but how do you see this panning out in the next 18 months to 2 years?
I think it's important to understand some of the key factors which drive the repo rate. I think Daniel alluded to some of the domestic factors which influence where the interest rate goes in terms of containing inflation domestically. But I think over the last 40 years, with the opening up of trade and the opening up of economies, you know, it's become a global village. All economies are linked together to some extent or the other. Then if you look at the last 6 years, what we've seen in the US is that their base rate has been as low as 0.25% over the last 6 years. What that has meant is that it's been cheap money. People can, technically you can borrow at 0.25% in the US and invest in a place like South Africa at 7 or 8 or 9%. So now, speculation is that as the US economy is recovering, the US Reserve Bank will start to move those interest rates higher. Effectively, what that means is now, some US investors might actually find it beneficial to invest that money within the US rather than taking that money offshore. So it's about the actions of the Reserve Bank, which might also dictate the actions of the South African Reserve Bank.
Exactly. It's going to be a case of money flowing back into the United States as their interest rate, their policy rates start to rise. Investing in the United States starts to become a more attractive proposition relative to it has been over the last 6 years. And so what that means is that money flows back out of emerging markets such as South Africa back into the United States, and it starts to cause some pressure on currencies like the rand. And as we've gone through in a previous question, that starts to impact on inflation through the import bill. Now the Reserve Bank indirectly is going to have to track central banks like the Federal Reserve in the United States and even other large G4 central banks to some extent in order to maintain some kind of currency stability and hence inflation stability over the next 12 months or so. So on balance, we do see further increases in the repo rate as quite likely in light of the action that we're likely to see in the United States.
Fahad, what does all of this mean in terms of the next 12 months for the South African economy?
You look, with interest rates moving higher, like Daniel indicated, anyone who has a car loan or a home finance, they will feel the pinch of it in terms of more of your income going towards servicing that debt and leaving less in terms of disposable income. So that will impact consumers negatively. It will impact consumption negatively. But on the positive side, it should bring inflation, or it should at least control inflationary levels in South Africa.
But I think it's also important to consider the fact that, as we said, as the US interest rates rise, South Africa will need to maintain some sort of attractiveness to international investors in order to keep some sort of stability in the rand over the next 12 months. So this means that we're able to fund our budget deficits. We have our budget deficit and our current account deficit through investor inflows into the economy rather than struggling to fund those deficits through investor outflows.
So Daniel, how do we look at things like we've done with the 12 months now? What happens after 12 months, the longer term?
Yeah, I think that's a good point because it's important to note that when we think about the long-term potential of the South African economy, things like the repo rate are not really large considerations. South Africans' problems are mostly structural in nature. So it's more about whether we can lift electricity capacity constraints over the next 5 years effectively. It's more about whether we can normalize labour relations over the long term, and that requires obviously some kind of political will. And it's also more about whether we can close our skills deficit. South Africa sits well below where we should be in terms of technical skills, education outcomes in the context of our average income. So those are the more important issues when you consider the South African economy's long-term outlook, rather than the repo rate per se.
Shafiq, I think the challenges we've just discussed over the next 12 months, and we discussed Greece, we discussed China, I think all of this just highlights the importance of having a diversified investment portfolio, to ensure that over the long term, regardless of which direction the inflation is going in, or regardless of which direction the rand is moving in, to ensure that your savings are protected against depreciation of the rand, are protected from inflation in South Africa. And I think that's where Oasis, as an investment manager, can play a very important role for its clients.
And thank you to our guests this evening, Daniel King and Fahad Sheikh. You have been watching the Oasis Focus on Finance show, and don't forget, we'll be coming to you every single week. We have been discussing the local and international markets. We examined Greece, we looked at China and the increase in the repo rate in South Africa, the short-term and the long-term benefits. Next week, we will be talking about retrenchments, what happens when you reach that financial crossroads, with wealth managers Mansoor Mir and Ibrahim Rawat. Should you want to contact Oasis, you can call 0860 100 786 or www.oasiscrescent.com. Until next time, I'm Shafiq Morton. Assalamu alaikum wa rahmatullah.